Hello, everyone, and welcome to a new mini series in the Exponential Edge podcast. This mini series is going to be about valuation when it comes to the lens of private equity, venture capital, and private and public companies. This first part of this two-part mini series is going to be about the basics of valuation and defining common terms in the field. I'm joined today by two investors at Avataar Ventures, Krushi Jain and Gulshan Dhanani. Hey guys, how's it going?
Good, good. Glad to be here.
Glad to have you guys. All right, so let's just start it off right away, right? This is the basics of valuation. So, what better way to start than with defining what valuation is, right? When you look at a company, say ChatGPT, right? OpenAI, they're worth nearly $300 billion dollars. At least as of March 2025, they were worth $300 billion dollars. So, for our viewers, how do investors even come up with that number of $300 billion dollars? At the most basic level, what is valuation?
So maybe Arya, I think I'll take a first jab at it and then I think Gulshan can chime in as well. So how we look at it, Arya, is basically valuation is just an estimate of what a company's worth is today based on what investors are willing to pay for a share of that company, right? It is not always
Mm-hmm.
tied to the
Yep.
current profits or revenue. It's basically the future potential. It talks about the future potential of the company. How much do you think that the company would be worth if the narrative today materializes, right? And valuation matters a lot because it determines how much of the company a founder is giving up when he's raising money. It matters for investors because it talks about how much returns you'll end up making on that company. It sets expectations, right? If a company is valued like a rocket ship, it needs to grow like one, right? So, if I were to summarize, valuation isn't just plain simple math. There's a lot of nuances to it. It's a lot. There's a lot of art, right? So I think that's how we look at valuation. It's basically what you expect the company to be worth.
Yep. Mm-hmm.
Yeah, and I think it's also as a price tag area. It's part math, part
Yeah.
imagination, and part also building some conviction, right? Like the
Mm-hmm.
OpenAI number of 300 billion. It's built up on some of math.
Yeah.
That there are revenue estimates of OpenAI doing about 12 billion a year, growing about I
Mm-hmm.
think what 50, 60, 70% year
Yeah.
over year, right? So that's the growth math that's factored in. There is also proxies, right? How do companies that are at say multi-billion dollars in revenues, frontier tech companies, how are they valued, right? So you put a multiple or a factor on that, and then the third part is conviction, right? Do you believe, or do the investors believe that this is the biggest company in the AI space today? Will it end up displacing a large part of not just current market share but also future market share as well? So those are the three things that sort of end up coming to that number.
Mhm. Yep, and I'm really glad you guys highlighted that it's not just a current estimate, right? It's a future estimate. It's not just what this company is doing right now; it's what they're going to be doing in the future.
Yeah, yeah.
And it's a mix of things, right? There are multiple techniques for valuation, right? As I was prepping for this episode, I read that it's sort of like a football field of valuation, right? There's multiple different ways and multiple different skills, and you compare those skills like comps, DCF, EBITDA, whatever it may be. And we'll get into those later on. But first off, I did want to go into a bit of a small case study on one company, right? Reddit, which all our viewers should know from many years. They went public last year,
Yeah.
and they were actually barely profitable, right? So when venture capitalists like yourselves invested in Reddit years ago at their startup stage, right? How would they have thought about valuation, right? When this company seems barely profitable, um, might not have high potential, right? How do they think about this company while investing early on?
Um, yeah, so see, right, and that's probably the beauty of valuation, that it like beauty depends on the eyes of the beholder, right? Or who is what's the horizon of the investor? What stage of the company do they typically come in, right? Is it like early stage, pre-revenue, pre-product, or even going to growth stage, which is where Avataar
And if
Ventures sort
this
of
isn't
plays, and then
this isn't the direct focus of this episode, but if you guys could just give a little, like a brief overview on the different stages of
yeah.
investing, that would be great.
Yeah,
Just to
yeah,
give a little.
definitely. Yeah. So to give a little color, right? Investors, I mean, investors comes in all sizes and shapes, and depending on what stage of you are as an entrepreneur in company building, you go to the right kind or right profile of investors to raise capital from, and it matters because you're taking a different kind of risk, and to the investor, and as an investor you're supposed to make a different kind of return, right, for the profile of risk that you end up taking, right? So for example, um, um, early on there are like angel investors, right? People like the three of us who can invest like small amount of capital to a startup, right, to get an idea off ground. Then there are companies that are pre-seed and seed funds that are basically helping you get your initial product or an MVP in shape, and find some real users of the product, right? Real, hopefully paying users. Once you get that, to get convert those users to say paying customers, right, and then to start adding
Yeah,
multiple
yeah,
customers, you get to, like, and then the series of funding start, right? So pre-seed, seed, and then stage series A, right, which is to get your initial set of customers. Then series B, C, which are more like growth stages. The once you figured out that your product is working, you found out who are the right customers for your product. You just keep the repeat motion on, right? Keep hiring more, keep investing more to grow. And then finally comes, like D, E, F, and beyond, right? And the letters continue and go on to pre-IPO, IPO, etc. Um, Go on to the growth stage and late stage, and finally the public markets. So each of these in the investing value chain have a different risk profile and different kind of capital that they end up putting in. To Reddit, for example, right? Like, in the early stages of a company, you're betting more on the potential, right? And potential, then you can farm out from different things, right? You can farm out from the kind of team that they have. Do they have like an A team who is not just good at building a product but also figure out a path to monetization later on? Second is, with the team in place, are there really existent parts of monetization that are available? Right. For example, you could serve ads. You could have, say, private Reddits, private subreddits, company sponsored Reddits, etc. Right. And with and you measure these via, say, user growth, engagement, time spent on website, MAUs, DAUs, user engagement metrics, right? Because while those are not immediately monetizable, but those are the real proxies of what you could go and sell to an ad publisher, etc. And then the third thing comes is, so once you have had once you're betting on the team, you have seen some metrics of future monetization. The third thing is, how do you value this company at this point of time, right? For example, so in the absence of any real revenues or profits in this like early stages of Reddit, the proxy that you could use is, it's a social media company. Could it become the next Facebook, or could it become the next Twitter, right? Given that it's a text first sort of company, so you use that proxies, and what is Twitter valued at that point, or what is Meta valued at that point, and that's again, so depends on who's seeing the company, and then you bring in like these lenses of part math, part conviction, part comparables.
Mhm. Great. Thank you, one, for going through that base summary of the different stages, and thank you for that insight on Reddit. now, like I said, we're going to go through some of these different techniques and terms that are in valuation, right? So when we talk about a company like SpaceX or Stripe, these are companies valued at billions of dollars, but they're also not publicly traded. So how does an investor decide what a company that's not publicly traded is worth? Right? There's no market cap to look at. Um, could you walk us through what one of the most widely used terms in finance in general, EBITDA, is, and why it's such a widely used number in these types of conversations?
So, I think I'll break the question down into two parts, right? The first question on how a private company like a SpaceX or a Stripe would get valued, right, when it's not publicly listed. So, when an investor is investing in a private company as such, right, the most important aspect that they look at, and I think even Gulshan touched upon this previously, right, or on how these companies that are publicly traded are looking like, right? So, for example, for a Stripe, something like a PayPal is a listed company, right? So, what would be the financial metrics? What are the PE ratios? What are the other metrics that it is reflecting today, right? So, for example, if Stripe processes payments like PayPal or Jain and those trade at 15 times earnings or 10 times revenue, right? Stripe's multiple would get benchmarked to that in that range. Then they look at key metrics. One of the most common, like you mentioned, is EBITDA, right? So yeah, certain metrics like that. And to your question, what is EBITDA, right? EBITDA is basically earnings before interest, taxes, depreciation, and amortization. It's basically a way of looking at a company, how much of operating profit a company is able to generate out of its core business before taking a look at things like loans, taxes, and other accounting stuff, right? It's core profit. That's how I would define it. Think of it as a way to answer if the company just focused on running its core business, how profitable is it, right? And
Yeah.
why is EBITDA so commonly used across, right? Because it standardizes the way you look at companies. It standardizes performance across companies, especially when comparing startups that might structure things very differently. They might structure their debt differently, leverage differently, uh, their taxes differently, right? So that's the core reason behind using EBITDA widely.
Great, thank you. And I did actually want to ask a bit of a follow up question. We'll get into cash flow in the next question, but I wanted to ask about the distinction between using EBITDA versus cash flow, right? Because a lot of people, a lot of investors, what I've seen is they like to use cash flow because they feel it's a more reasonable estimate of a company's actual success, right? Their liquid cash that they're able to use for capital or paying debt or anything, right? And EBITDA is sort of, like you said, just an estimate of their core profit. It's not actually the liquid cash they're able to use. So, could you kind of go into the distinction of when you should look at EBITDA and use EBITDA as the proper valuation tool or cash flow?
So I cash flows are typically used when a company is more mature and has more predictable kind of cash flows, right? In early stages of a company, you might not be having that much stable kind of cash flows. Your cash flows will be getting impacted by a lot of other things, right? Like your working capital, your debt, and stuff like that. So cash flow is a more stable metric that's looked at in more mature companies, whereas EBITDA is something that's looked at even in early on and lesser mature companies is the way that I'd put it.
Okay,
just
great.
to just to add, right, a lot of, like, in early stages of the company, you may not be even being net positive in terms of cash, right? But the way a discounted cash flow model works is, you're investing for a bit, but you're having positive cash flows, right? But say if I'm sitting valuing a company at series A, more likely than not they would be burning cash, right? So which means that a standard DCF model may not fully come into the picture. So that's why EBITDA would probably paint a better picture, and EBITDA would become the apples to apples.
Great, thank you. And talking about DCF, discounted cash flow, first off, if you guys could explain what discounted cash flow is and how you guys use it, and then we'll get into a small case study on two companies that project future cash flows.
Yeah.
So,
Krushi, go ahead. Certified accountant.
So yeah, discounted cash flows, right? As the name suggests, DCF is basically discounting the future cash flows that you'll generate from the business and what you're willing to pay for it today, right? That in its essence is DCF. It's basically a way of valuation in itself, but like I'd say, right, it's dependent on how good your assumptions are as well, right? Because you're projecting
yeah,
your
yeah,
future cash flows, so there's an element of growth involved to it. Then you're discounting it back
mm,
to present. Then there's a element of you baking in the risk in it, right? So yeah, that's
mm,
what a DCF model is in its essence, and it's usually used
great.
for more mature businesses, like we hinted at before.
Yeah, and the case study we're looking at here is two very mature businesses in Netflix and Tesla, right? Who have been using this DCF model for years, right? Even before their profits have caught up to what has been projected, right? So when they're using these future cash flow models, right, how realistic are their numbers in these cases, right?
So yeah,
You're also taking into account things like inflation as well.
yeah, think like I hinted at before, Arya, right? When companies like these are using DCF models, right, they're using a lot of assumptions that come with it, right? So you're assuming the growth rate that would come with it, the risks that needs to be baked in, the terminal value that will have to be assigned to a particular company. So yeah, so it depends on how good the analyst is and how good your assumptions are, and how it's at the end of the day boils down to you pressure testing your assumptions to build conviction on your DCF model.
Yeah. Actually, I'll just pick up on that couple of words that Krushi said, right? That it's more used for pressure testing or stress testing,
Yeah.
right? Less of what this company would be valued in the future, right? Because see, what you're really trying to do is at say to build a DCF, you're taking growth rate assumptions, risk assumptions, cost of capital assumptions, right, which is say the discount rate or the interest rate, right? So if your cash flows 10 years out are worth say $100, what's the value that you're willing to pay today, right, which is the present value of those future cash flows. So what you do is with that base DCF model ready, you start testing the assumptions. Hey, can I should is 30% growth rate for Netflix realistic year over year, or would it sustain at a 30% CAGR? Will Tesla sustain at say 30-40% CAGR year over year? That's one level of stress testing. The other level is would discount assumptions hold true, right, with how all the markets are playing out, with how capital intensive some of these businesses are. Netflix is less capital intensive versus Tesla being a little bit more capital intensive. So like your weighted average cost of capital and things of that nature may also end up being different, what you're paying for debt versus what you're paying for equity. So with those things varying, right, what you really are looking from a DCF is pressure test your assumptions and see how realistic of an output are you getting, rather than just thinking about keeping all the blinders on and doing valuing the company just on that.
Yeah, just adding to that, right? So you build your conviction when you build your conviction on the output, which is the valuation of the company. You start building your conviction on the inputs, the assumptions of the company. And
Yeah.
the good way to go about doing that is actually thinking, do you really think a Tesla or a Netflix can grow at this rate? Have companies grown at this rate before? Which are what is the segment that it operates in, right? What is the future potential for growth in that particular segment? Is that then when you come down to your WAC and things like risk, you start thinking about how risky is this segment? Are there geopolitical tensions that could impact that? Stuff like that, right? So you basically pressure test your assumptions.
And we'll get into those geopolitical tensions later on. But keeping with this trend of future projections, I want to talk about price to earning ratio, right? So, as an example, a few years ago, in I think 2022, Meta's price to earning ratio was much lower than what it had been a few years ago, right? I think it was about 13 when it was in the mid 20s the past few years. But they were still making money, right? They were still making profit. So analysts debated whether this price to earning ratio was too high or too low. So I wanted to ask you guys what a price to earning ratio really is. How should young investors think about it? And what do these different numbers mean, right? What is a high price to earning ratio? What is a low price to earning ratio? And what does that tell us about these companies at that point?
Yeah. See, PE ratio, price to earnings ratio, it's essentially super simple, right? It's how much dollars are you willing to pay for $1 of annual profit, right? So a PE ratio of say 30 implies that you're willing to pay $30 for just for that company to make $1 of annual profits, right? Which is the earnings that are reported. The essence is, in most cases, PE ratios vary by. You should not be looked at isolation, right? If I'm paying a company, like a PE multiple of 20, that does not tell me anything, right? That that may be high compared to the sector, that may be low compared to the growth profile, that may be stable, or unstable compared to the larger macro conditions, right? How public markets are faring in, how inflation and everything else is faring in. So that's why it should ideally be given a lot more context. Should be compared to, like sector specific PE, at the bare minimum. So for example, you would essentially see high growth or high tech companies always trading at a higher PE multiple than, say, consumer or utility companies, in general, because again, the sector growth profile looks very different. It's assumed that high tech profits are generally high margin profits, generally sticky in nature, and growth is easier to acquire, than, say, consumer, where you have to build a lot of distribution out, than in utilities, where you have to build a lot of infrastructure out to get to that growth, right? So for example, if I am doing $100 this year, and I have to I my PE ratio assumes that I'll get to, say, $120 next year, right? So I have to add a 20% growth. It may be easier for tech companies, may not be for certain other sectors, right? Depending on what's the precursor for providing that
Hmm.
growth.
Like for a
So
SaaS company, it probably would be easier than for like an electrical
exactly.
company.
Yeah. And that's why across markets, right? And it also differs by region, right? So US would effectively follow a different multiple, and compared to how their public markets
Yeah.
value EBITDA, versus, and this is the nature for Indian markets, right? Just for everyone to know, Indian markets are very profit sensitive, so you will see, even for similar profile companies, having a higher EBITDA, like having a higher EBITDA multiple, which means they are also greater sensitive to EBITDA than like the US companies.
Awesome. Thank you guys for going in depth with price to earnings. And still talking about that Twitter deal, right? It was actually a term called a leveraged buyout, right? So if you guys could define what a leveraged buyout is, explain how it works, and why someone might use a leveraged buyout approach instead of just paying cash or fundraising equity, right? Why would someone borrow a large sum of money and put so little of their own money in, right?
Sure. So, in its sense, Arya, a leverage buyout is when someone buys a company mostly using borrowed money, right? And
Mhm.
then uses the company's cash flows to pay off the debt over time. You can think of it very easily like you're buying a business the same way most people buy a house, right?
Yeah.
Using leverage, using mortgage, right? So you have a homeowner's equity and then you have some bit of a mortgage to it, right? Just to put things into perspective, let's use an example, right? Let's say you're buying a company for $1 billion. You put in $200 million of your own money. That would be called equity. You borrow
Yeah.
$800 million from banks or private lenders. Usually that's the case. Now you own the company, but it has $800 million of debt on its balance sheet. After that, once you own the company, you need to service that debt, which happens every year, right? Any profits or cash the company generates goes towards paying off the debt before any equity owner can be paid off or any year EPS happens, right?
Yeah.
Mostly people use LBO, debt and leverage, whatever term you want to call it, or instead of just cash, right? Because of multiple reasons. Debt is cheaper than
Hmm.
equity, right? And you
Yeah.
end up making higher returns. If things go well, using a debt can magnify your returns. That's why you call it leverage, right? You
Yeah.
control $1 billion of a company in our example by putting in $200 million of your own money. That's it.
Mhm.
800 million is somebody else's money. You keep control of the second reason would be you keep control of the company by not raising equity from others. You don't dilute your equity further, right? So you
Mhm.
keep a good control of the company. So these are a couple of examples. And thirdly, in a more financial and accounting perspective of it, right? Debt helps you claim tax benefits. Debt
Yeah.
forces cost control, and then you obviously debt is tax efficient that way. Uh, Having said all of these good things, right? It also comes with a huge risk, right? If the
Yeah.
companies mostly leverage buyout in scenarios that we've seen is for companies that have stable cash flows, right? Because if the company's cash flows drops, it might not be able to repay the debt, and then that can lead to bankruptcy or forced asset sales. That's why usually LBOs are used with stable cash generating companies. In the case of Twitter, when you would have seen Elon Musk using a high amount of debt, right? Right after that, you would have seen a series of firing, a series of monetization strategies come
Yeah.
into place, right? And a push to make the company profitable and generate cash flows.
Mhm.
This was one of the key reasons. He
There's
had
a
like,
huge pressure for this
yeah, there
company
was
to
a
be
huge
profitable.
pressure. Correct, exactly. Twitter was responsible to pay at least like the number I recall, $800 million to $1 billion in interest in itself on taking the debt, right?
Yeah.
So Twitter in itself wasn't a highly profitable company to begin with.
Mhm.
So the hope was anchored on Elon Musk to turn around the company, make it
Mhm.
profitable. Yeah, that's where the debt came in.
Great. So it's really just a high risk method of potentially making a great return on investment, but there's a lot of variabilities.
High risk when you talk about companies that are not really stable or not really monetizing, right? And like I highlighted before, LBOs are usually used in mature and more cash cow kind of companies. So more
Yeah.
private equities use it rather than early stage VCs or
So it's really used on things that are more of a sure deal, right? Okay. Great. So now I just want to shift lenses a little bit and talk about the geopolitical scape of investing venture capital. First, we'll look at the actual geopolitical tensions that affect investing. One of the biggest ones, obviously, the US China trade war, specifically the chip war affecting companies like NVIDIA and Taiwan Semiconductors, right? Which saw massive valuation swings because of these new legislations, right? So, how, in your words, in your minds, how do geopolitical tensions actually show up in the valuation of companies?
um, Effectively, again, comes down to, if I just look at the math part of it, right? Keeping sentiment, and because sentiments are, like, time sensitive, and they swing widely. But if I were to look as a long term, long term investor, and look at, say, geopolitics and how it plays out, you got to go back and look at math, right? So basically, like we said, revenue, valuation is more about revenues and margins, right? So you got to be, um, sensitive of how much of your revenue is now subject to that geopolitical tension, how much of your margins, or like, which goes back to your supply chain, are sensitive to the geopolitical tension, right? So, and there are a lot of examples, right? For from the same chip war, two leading companies might benefit, or like lose out on different aspects, right? So someone might be at a benefit, someone might be at a loss, right? So say with the chip war, if you look at a company like Taiwan Semiconductors, right, which is sort of the largest chip manufacturing in the world, they have Chinese supply chains, right? So most of their supply chain would essentially either end up getting impacted or heavily tariffed, right? Which means that your margins are eaten up. But if you look at, say, companies like Nvidia, right, for them, they're a net consumer of those chips and converting it into a, like a GPU, right? So for
Yeah.
them, the wave that we are looking at only, say, US based chip manufacturers or US based, GPU manufacturers, that same thing may play out as a tailwind for them, right? That now that China or Asia based companies may not have a win in this market, like US companies may end up winning, right? And who is your net
That's why
buyer? Your
there's such a shift in a need for the reshoring of manufacturing, right, to
Exactly.
these US
Yeah,
and
yeah.
Western countries.
Yeah, and it plays out in other industries as well, right? If I were to look at, say, US based, slightly high cost chip manufacturing, like TMC equivalents, but in the US, they would end up now they would see a big tailwind from this, right? So, effectively, what I'm getting at is, you have to look at it from the lens of, like, very simple revenues and margins, and then play it out accordingly, right? Even with most of our portfolio companies, even while they are software companies, again, tech companies are generally built as global businesses, may have some hardware component in it which may be subject to some tariffs, etc. So you, as an investor, you have to look at the long term lens and factor the valuation than the near term tension.
Great. And you talked about how in different countries and different geographies, different companies are going to be valued at different multiples, right? They're going to be valued at different multiples, also based on obviously the currency as well. But just at a basic level, in different geographies, different investors invest differently, right? Forgive me if I'm wrong, but in the US, usually VC firms are more risk based, right? And product oriented. Say in Europe, they're more, I wouldn't say calm, but they're more relaxed. They're more about profit, real numbers, and what have you done so far. And India is sort of a hybrid of both, right? It takes a good mix of both of those views. So if you could go over why and how valuations are so different in different geographies, that'd be awesome.
Yeah. So effectively, and this is something that we started on the earlier question as well. The difference comes in from multiple things, right? How mature are the financial markets in the two countries that you are comparing? What kind of end markets are there which the companies or the startups themselves are pursuing, right? So those are the two things that really play a big part. For example, the majority of financial markets, right? If the public markets are fairly well established, fairly stable, in a country, they have seen a lot more tech IPOs or tech companies being public, like for the past couple of decades, um, that that builds a greater appreciation startups in general, and young
Yeah.
companies building businesses, versus say regions like India, which have traditionally seen only fairly stable, profit making, cash generating companies IPOing, or getting into the public markets. You tend to form the same lens for every other company, right? You Even for tech companies which follow a different J curve, a different growth curve, right? Like, the once they start producing profits, it's a lot of profits, right? So but for a long time there are no profits. So until you build that mentality as a market, it's difficult to build that appreciation. But always it's a moving goalpost, and it improves over time. So that's why traditionally, US markets have played a like a more mature role, and India is catching up. And like India has been more profit sensitive, like I said initially, versus US is still more growth sensitive, right? So at least from the tech companies, they expect like growing valuations, and they're paying the risk
Yeah.
premium for the growth valuations. The But frankly, we've started to see the reverse as well, right? Because
Hmm.
with US,
Hmm.
a lot of companies are there in that 300, 400, 500 million revenue ranges, right? Waiting to IPO, waiting for IPO markets to come back. India has become a better market now, given that the same scarcity of tech companies is playing in the favor of Indian companies, right? That because there are not a lot of tech companies, because there's growing appreciation for tech startups, good high growth businesses. So that's the promise that Indian investors are now willing to bet on as well, and a lot of companies are now considering whether to aim for like a US IPO versus an India IPO. So that was the quick context on the financial market side. But the other one is the TAM, right, or the total addressable market. Like, how big could a startup become if they were based and or selling in the US, versus they were only serving India, right? So that also serves as a lens for different investors, right? For example, like an India company serving only Indian, say, software buyers, right? Which is a fraction of the US software buyer market, right? So that's why, like, when I would factor in the potential of this company to grow within India and to sell more software within India, I would I would be worried about how big is the addressable market, right? And the addressable market reflects how big my revenues could be from this company, and effectively what's the return that I end up making as a multiple on that. Versus in the US, because the market itself is big, it's mature, it understands software buying cycles, so you're able to figure that out, right? And you're not so worried about the company being saturated at one point, or company stalling in terms of growth, because there's a large leg room to grow within.
Yeah, but like you said, India is really catching up when it
Yeah.
comes to investing funds, especially because of AI, right? Like, I was interning at a US based tech company, but 200 of their like 250 workers are based in India, right? And most of their
Yeah,
work has to do with the AI boom, right?
exactly.
They're I'm blanking on the word, but they're most of their workers are AI workers in India,
Mhm.
right? And Indian
Mhm.
VC firms, again, forgive me if I'm wrong, really are focused on that tech investing, right? AI, technology, fintech, and that's the industries that are booming right now. So India is really catching up. And just the final thing we'll go through today, I wanted to ask a question that can help some of our viewers who may want to go into VC investing, finance in general, right? And I myself am a high school student who could benefit from this answer. So we talked about all these case studies, the Twitter acquisitions, AI booms, IPOs, chip wars. Um, so for people who want to work in VC, PR, finance, what's the mindset that you should have going into valuation coming from people who value companies for a living?
So, I think I'll take a first jab at it, right? And so this is something very core to Avatar, very core to what we do over here, right? One mindset that we follow over here is what has to be true, and for this, like literally, what needs to be true, right, for this narrative to be played out, right? Whether you're looking at a $300 billion AI company or a buzzy IPO or a founder pitch, you don't need to just buy into the hype or the narrative.
Yeah,
Just need to separate the story from the numbers and then rebuild the story from the numbers, right? uh, to simplify it, what I'd say is think of the business in terms of revenue growth, cash flows, risk, and time, right? And most importantly, get curious about the assumptions that would go into building the narrative out, right? It's not being skeptical, but it's being always curious and understanding at the core what the business means.
Yeah, yeah. I think I'll just like add to that similar thing, right? You have to question and from a curiosity mindset, right? Like less from
yeah,
a skeptic or a critic point of view, but you have to continuously question. Say OpenAI reporting a like a 300 billion valuation, Cursor reporting whatever valuation they end up reporting. You have to go back and apply like the same lenses, right? From the math lens, why would a company be raising at such a valuation, right? From a conviction lens, do we believe that this is the company to go back to, or this is the company that will end up becoming the winner? So the question everything mindset really helps, right? And that's something that we do day in day out as well, right? Because most of the companies that we end up meeting don't have a lot of comparables. They are first to market, right? So you have to go back, question on first principles, whether we believe the company could be this much, and are we paying that kind of are we okay paying that kind of premium, depending the stage of investors that we are. So as budding investor, you don't need to worry about all that. Just that every acquisition, or every financial transaction, or every fundraise that happens, question it, right? If someone, say Microsoft, has like put in a large bet on OpenAI, why would have they done it, right? From a tech standpoint, or when Meta recently acquired a data labeling company, Scale AI, right? Why would they be willing to invest in that and pay, say, $10 billion for that? Right. So go back and question, and you'll find, say, some synergies, some meaningful, like revenue metrics, and like a combination of all of these will inform you
yeah,
to become greater investors.
yeah. Thank you guys. And I'm sorry to keep you a little bit, but I did have a follow up question that just came to my mind. It wasn't on the list of questions. Again,
Go ahead.
sorry to keep you guys, but I was interviewing another venture capital partner, a growth equity partner, in one of my prior episodes, and we talked about the idea of what an investor looks for. Right? Is it more important to have a great team for your startup, right? That covers all the bases, highly driven, knowledgeable, or is it better to have an amazing product, right? What do you guys look for more, right? Would you invest in a team with a okay product, great team that you believe can make it happen, or amazing product, good team, right?
I think it's rarely that probably one or the other would end up happening, right? If you have an okay product with an amazing team, they would probably figure out ways to do what to do with that product, right? Either they would figure out, say, and maybe the third lens is also a go to market, right? Who you are selling to, an okay product but a refined go to market model, right? You may end up beating, say, a great product, but with a shitty go to market, right? Because they've not figured out what to do with it, right? How to continuously make money from it. But what we've what we have, again, in our short stints as investors, right, but in general, like, the fund has had a longer life. What we've believed is, great teams generally outbeat just great products, right? Because great product is essentially a point in time assessment. The product may be great at that point in time, but a great
Yeah.
team
Yeah.
effectively plays out as a great team over time. I don't know,
Like,
Krushi, if you differ.
no. Just to add to Gulshan's point, right? Execution is everything at
Yeah.
the end of the day.
Yeah,
That's what
yeah.
matters.
Mhm. That's a message to all our college, high school, entering the workforce viewers who are planning to make a startup, get into business. That they're not just investing in the product; they're investing in you as the person, right? They're investing in you and your ideas and your work ethic. So thank you guys so much again for joining us for this first part of our valuation mini series. And for our viewers, thank you so much for watching this first part on the basics of valuation. Join us next time as we go into the distinctions between private equity, venture capital, and public and private companies when it comes to valuation. Again, thank you guys.
Thank
See
you
you
so
guys
much,
next time.
Arya.
Thank you.